This one as well doesn't say that, we're giving out cash or anything like that, so it makes sense why we would not use cash. So there's actually since there's a debit balance of the 15,300, and then all of a sudden there's and there's also a credit, the same title, supplies on hand, for the 12,600, you would subtract those two, and then you're trying to figure out from that subtraction what plus that number would get us the 11,400, and then that's what the 8,700 is. This answer is from chapter 3, from the slides the PowerPoints that you gave us. From slide 41, it straight up says liquidity is the ability of a firm to satisfy its short-term obligations. For this one, it makes sense that the answer would be there must be a past transaction or event, because it wouldn't make any sense for where would the liability come from if there wasn't a past event that happened. Because if a past event didn't happen, then a liability wouldn't exist. From the slides that you gave us from chapter 3, slide 9, it's right under the title non-current assets, and intangible assets is listed. I'm actually not very certain on why that is the answer for that question. I guess because of problems, and if things are not reported, then that is putting a limit on that balance sheet. You want it to be separated from the component income continuing operations when it is infrequent in occurrence but not unusual in nature. And I guess it makes sense because you want it to be separated because if it's infrequent, then it's not very common for it to happen. So then you'd want to separate that from the component of income from continuing operations. So generally, for like accrual accounting, it says that we recognize the revenue as they are earned, not necessarily when cash is received. So it makes sense that we recognize the revenues at the point of the sale and not when we receive the cash. For the wholesale bakery, this also makes sense that they'd normally recognize revenue when the goods are delivered to the customer, because just for the accrual accounting, they recognize the revenue as they are earned. So the bakery didn't necessarily receive the money yet, but as soon as that item was delivered to the customer, then they earned to say that their revenue, to recognize their revenue. If I'm looking at this one right, it makes sense for the cash disbursement to not be an accessible basis for the recognition of expenses, because it's hard to have proof of cash being spent. You won't really have a trail like you would with like a credit card or a check, because you have pictures of the checks, you have the credit card numbers and information that are traveling for you to recognize expenses. Well, with cash, you don't really have those things to be able to track cash. So that's why it'd be cash disbursement is the answer. The answer you could get from chapter 3, and I looked on the slides, so it's chapter 3, slide 34, and it says under accumulated other comprehensive income that the FASB requires companies to summarize changes in owner's equity exclusive of net income and contributions by and distributions to owners. So that right there is the proof of the answer of number 35. For doubtful accounts, which appears as a deduction from accounts receivable on the balance sheet, is an application of and the answer is matching principles. Matching principles directs a company to report an expense on its income statement in the same period as the related revenues. So it kind of makes sense for you to do matching because it's helping you to direct companies, and this is doubtful accounts and helping because they're doubtful, probably helping to where they should be labeled. Makes sense that the forecasting begins with a forecast of sales. I'm not sure if this is right, but for accrual accounting, we recognize a revenue at the point of the sale. So that's the beginning. So it makes sense that it's point of sale and not cash. And also in chapter 4, slide 94, it says that they start with the forecast for sales.